Welcome back, ladies and gentlemen. Now we're going to do a class example regarding the correction of accounting errors. Let's have a look at the information quickly. During 20X4, Company X discovered that prepayments of 400 currency units, let's say rands or dollars or euros, made during 20X2 had not been recognized in profit or loss as related expenses were incurred. So what they did is we originally put everything into prepaid expense, which is an asset, when it was paid. But as the actual expenses were incurred, we did not take it out of prepaid expense and put it into profit or loss. The following prepayments should have been recognized in profit or loss: 20X2, 100, 20X3, 250, 20X4, 50 altogether. That is the 400 prepaid expense all used up. The misstatement is material. I said assume a tax rate of 28% and that the expense was tax deductible at the earlier of payment or accrual, which is pretty much always how it's going to be. So what was recorded? We've shown you that there was a debit prepaid expense, which is an asset in statement of financial position of 400. The credit was against bank. This is not all that would have been recorded, ladies and gentlemen, because along with this there would have been deferred tax, right? So along with this we would have had a carrying amount of 400, a tax base of 0. Remember, the tax base of an asset is equals to future tax deductions. When did we get the deduction for this? As the amount was paid. Okay, temporary difference, 400. Deferred tax would have then been 112, being a liability. Assuming there was no other temporary differences, our opening balance would have been 0. The movement would have been 112, which means we would have gone debit, deferred tax, profit and loss, credit, deferred tax, financial position, 112. Okay, I hope that makes sense. We now have a deferred tax liability of 112 as well as a prepaid expense, an asset of 400. Now, what should have been happening in 20X2, 3, and 4 is we should have been taking some of this to an actual expense in profit or loss and reducing the related prepaid expense, which is a financial position account. But this never happened. Okay, we've got to ask ourselves why. Okay, we maybe had a bookkeeper who either forgot about it or was incompetent, but for whatever reason this journal was not done. So a big 0 was passed through, if anything else. So as a result of that, the 20X4 financials, which should be 20X4 and comparatives, I've just included the 20X2 for illustrative and information purposes. But let's say we had revenue of 6,000, 4,000, and 2,000, expenses of 3.5, 2, 6, and 1. Remember, this expense is before correcting the error, please. Okay, so the error is not corrected. We have profit, then we have tax expense. What I've done is I've split the tax expense on the face. Usually they'll get done in the note, please, but we have current tax and deferred tax expense. The journal I just showed you is that they had passed a deferred tax expense of 112. Current tax would have been worked out in 2000 as the 1,000 minus the prepaid expense. I told you to assume that was the only temporary difference. Would have given me taxable income of 600 times 28% gives me 168. If you check, the 1,000 times 28% gives me my total tax expense of 280, made up of current tax and deferred tax expense, leaving a net profit of 720. Now this column should not be in the financials, no matter what, because it's these statements of profit or loss. You never do the second prior year. It's purely there for illustrative purposes, for information for you to do this question, please. Then the next 2 years, we had profit of 1.4, profit of 2.5. The only tax I've assumed here is current. I said ignore all, there was no other temporary differences. So 1.4 times 28% gives me 392. 2.5 times 28% gives me 700. Profit 108 and 1,800. Next up, there would have been a prepaid expense in 20x2 of 400, a deferred tax liability of 112. Remember, we went from 0 to 400 prepaid expense, with the related tax liability going from 0 to 112. The current tax, we're assuming we went debit current tax expense 168, credit current tax liability 168. Okay, and that's raised. 20x3, I've assumed the 20x2 is fully paid. Only the current tax liability of 392, and for 2004, only the current tax liability of 700. Take note, the big problem is the prepaid expense is still sitting there as the full 400 in both years. So that just shows that the error, yes, is still not corrected, right? Because everything is still sitting at the 400 prepaid expense. Nothing has been taken out to profit and loss. Retained earnings, we add the profit of 720. The next year, we take the opening balance 10,720 plus the 1,080. 2004, we have a profit of 1,800 added on. Okay, so this is all the information given to you before you need to go and do the correction to the errors. Okay, now in 20x2, let's do the journals quickly. You are going to have to debit the expense in profit or loss. You will have to credit the prepaid expense asset in financial position. And the figure there was how much? Let's just quickly go back to the question. It should have been 100. So, debit the expense, credit the prepaid expense, 100. Okay, then we have to do the tax quickly. The tax had carrying amount, tax base, temporary difference, deferred tax. We had a carrying amount now of the 400 minus 100, giving me a carrying amount of 300 being an asset. Tax base is 0, temporary difference is 300. Deferred tax then would have been 84 being a liability, please. The opening balance was 112 liability. So what has happened here? We have decreased the liability by an amount of 28. What do I do with that, ladies and gentlemen? I'm going to go and decrease the liability by debiting deferred tax financial position and crediting deferred tax expense, which I call deferred tax P&L, 28. So I've made the liability smaller. Okay. Now, along with that, I just need you to understand that in 20x2, that is the second comparative, right? The second prior year. I do not have to restate the statements of profit and loss. I have to restate the statements of financial position, but not the profit and loss. So I'm not going to take that to expense. I'm going to take that to retained earnings equity. And then the deferred tax is not going to go to deferred tax expense. It's going to be retained earnings equity, being 28. The net effect on retained earnings will be, the net retained earnings effect will be the expense of 100. Remember, here I increase the expense, therefore I decrease the retained earnings, and then the deferred tax expense, well, that I credited. I made that smaller. So I make an expense smaller, I increase my profits, which increases retained earnings. Therefore, an overall decrease in retained earnings in 20x2 of 72. Okay, you've got a feel for the journal now. Now I want you to do, please, the 20x3. Here you do have to restate the comparatives for profit and loss as well as statements of financial position. Push pause, take a minute, and go and do these journals, please, yourself. Then come back and watch me work through it with you. Push pause now, please. Assuming you've done that, let's now go and do the 20x3 correction. We're going to once again debit the expense in profit or loss, and we are going to go and credit the prepaid expense in the statement of financial position. And this time, this year, it was a large amount, 250 if I'm not mistaken. Not that difficult, right? But what you do have to do next is a little tricky, and you have to do the deferred tax movement. You have the carrying amount, the tax base, temporary difference, and deferred tax. The carrying amount was 300. You are subtracting another 250. You are now going to have a closing balance of 50. The tax base, well, the tax base of an asset, remember prepaid expense is an asset, is going to be what? 0. Tax base definition of an asset, please go and watch our series on deferred tax, but the tax base definition of an asset is future tax deductions. There's nothing left to deduct here, guys. Everything has been deducted in the past. When the first 400 Rand was paid, the tax man gave us the full deduction. So temporary difference now is 50, okay, and that is a future tax liability, being 14. Okay, now that is a deferred tax liability. The opening balance was sitting at 84, being a liability. We will now decrease the liability, okay, from 84 to 14. That decrease is a movement of 70, and we're going to pass our deferred tax journal, debit deferred tax financial position, make the liability smaller by debiting it, right? 70, credit deferred tax, profit or loss, 70. Okay, so profit and loss movement was, we made the expense bigger, and we decreased the tax expense. So the net effect is the 250. So the net profit effect, we increased by making the expense bigger. We increased the expense, decreased the profit. The tax expense got smaller and therefore increases profit. The net effect is 180, being a decrease in net profit. Okay, making sense, I hope. Now, 2004, remember something here in 2004, that the annual financial statements are not finalized. So there is, therefore, no adjustment that's going to be disclosed at all. All you're going to do is put through the correct figures before they are authorized and finalized. The adjustment that you'll need to put through here is debit expense, credit, prepaid expense. Use up the last bit of the asset, the final 50. Tax, well, what's happened with the tax here now? You're going to go and have a carrying amount now of 0 because you had 50 and you used it up. Your tax base is 0, temporary difference is 0, deferred tax is 0. But you did, however, have an opening balance of deferred tax being 14, being a liability. So I decreased the liability by the final 14. Okay, decrease the liability, once again, debit deferred tax, financial position, credit deferred tax, profit and loss, 14. Okay, nice and easy. Now I need you to take these journals, make sure you can work with them, and then we're going to move on to the disclosures for a minute. Okay, so disclosures, let's have a look at the extract from the notes. Here we're going to have a prior period error note. Okay, And all you're going to tell me is during the year, company X discovered prepayments had not been recognized in profit and loss. That is the what? The prepayments have been recognized as an expense of 100 in 2012, 250, and 50. How did you correct it? Okay. And the final thing to tell me is that the financial statements in 2013, which is the prior year, okay, have been restated to correct this error. The effect is summarized as follows. And here are the figures that we're going to need to put in. The end result, the end game, the output that you need to give to your users. The decrease or increase in expense, well, look here. I'm only doing the statement of profit and loss in 20x3. 20x4, nothing needs to be done. Why? Because you've already corrected them before they were authorized for issue. 20x2, you do not need to do the statement of profit and loss. The financial performance does not need to be restated for a second year. But you do need to do the prior year error, which is 20x3. So a decrease or increase in expense, well, we increased the expense, which is a decrease in net profit. We then went and decreased the income tax expense. If you decrease it in the income tax expense, you make the profit bigger, so it's a positive. The net effect, ladies and gentlemen, is a decrease of 180 net profit. Okay, then the statement of financial position. Here, you do need to do both the 20x2 as well as the 20x3 year. Remember, when you restate the financial position side, you need to do 2 prior years, please. So that's what I'm doing. Second prior year, I had a decrease in the prepaid expense. Okay, went from 400 to 300. Along with that, there was a decrease in deferred tax liability, which increases the net asset position. Okay, overall, I had a decrease in the net asset position of 72. What is net assets? Assets minus liabilities leaves me with equity, please. Okay. In the current the 20.3 year, 20x3, decrease the prepaid expense, the asset, by 250. Increase the decrease deferred tax liability, increases equity. Overall, a net decrease in equity of 180. Now this increase decrease seems a bit confusing, right? I need you to go and work this through. Remember, over here on the top, I'm dealing with net profit. I either have an increase or I have a decrease in net profit. Expenses that increase, okay, will decrease net profit. Tax expense that decreases will result in an increase in net profit. On the bottom, I'm dealing with financial position. Here I'm dealing with net asset value, which equals assets minus liabilities, which equals equity. Okay? If I increase equity, it's positive. If I decrease equity, I'm making it a negative. Okay? So if I decrease an asset, I decrease equity. If I decrease a liability, like my tax, I increase equity. Okay, I hope that makes a bit of sense. Please just remember, I don't have to do the current year when I'm dealing with an error. It's different to a change in accounting policy. Thank you, ladies and gentlemen.